Bond duration. Bond duration is a way of measuring how much bond prices are likely to change if and when interest rates move. In more technical terms, bond duration is measurement of interest rate risk. Understanding bond duration can help investors to determine how bonds fit into a broader investment portfolio. Duration is measured in years. Generally, the higher the duration of a bond or a bond fund, meaning the longer you need to wait for the payment of coupons and return of principal, the more its price will drop as interest rates rise. Because every bond has a duration, those numbers can be a useful tool and can be used to compare bonds as you construct and adjust your investment portfolio. It's also important to remember that duration is only one of many factors that could affect the price of your bonds. For example, graph shows % change in bond prices if rates spike 1%. It is hypothetical illustration of the effects of duration exclusively on bond prices. If a bond has a duration of 5 years and interest rates increase by 1%, the bond's price will decline by approximately 5%. Conversely, if a bond has a duration of 5 years and interest rates fall by 1%, the bond's price will increase by approximately 5%. Understanding duration is particularly important for those who are planning on selling their bonds prior to maturity. Bond convexity. Convexity demonstrates how the duration of a bond changes as the interest rate changes. Portfolio managers will use convexity as a risk management tool to measure and manage the portfolio's exposure to interest rate risk. Bond convexity is a measure of the curvature, or the degree of the curve, in the relationship between bond prices and bond yields. In graph we can see a straight line which represents the duration, whereas curve represents the convexity of bond. Convexity is a risk management tool, used to measure and manage a portfolio's exposure to market risk. Convexity is a measure of the curvature in the relationship between bond prices and bond yields. If a bond's duration rises and yields fall, the bond is said to have positive convexity. Whereas, negative convexity exists when the price of a bond falls as well as interest rates, resulting in a concave yield curve.